Hello and welcome to this presentation titled Credit Risk Management. This is another in the 10-minute tips program series for credit and collection professionals. My name is Michael Dennis. I'll be the presenter today. Let's begin with an introduction. There are any number of practical things that a credit decision maker can do to reduce the risk of bad debt losses. I believe that the best time to manage risk and the best way to manage risk is to carefully evaluate requests for open account terms received in the form of credit applications from new accounts. My personal position is that the time, energy, and effort that is spent evaluating whether an applicant qualifies for open account terms, and if so, how much credit to extend, is time that is very well spent. My position is that the best way to manage risk is to be proactive, and the easiest way to be proactive is to make the right decision initially in connection with new credit applicants. In addition, creditor companies can manage risk effectively by performing periodic reviews of their active customers. Today's program includes ideas for reducing the risk of payment default, meaning bad debt losses, as well as ideas for accelerating payment of delinquent customer accounts. Ways to reduce bad debt losses. Number one, develop a policy addressing how the credit department will go about setting credit limits. As it relates to evaluating new accounts, that would be more comprehensive than simply this is how we set credit limits. That policy would describe, among other things, who will review credit applications, what types of credit reports will be obtained, whether or not financial information will be required from the applicant, how that financial information will be evaluated, what methodology will be used to determine what is or is not an appropriate credit limit for that applicant company. Number two, create a policy within the credit department indicating how frequently customers' credit files will need to be updated. For example, do we do that once a year? Do we do that once every 2 years? Do we do that once every 5 years? There needs to be a policy in place indicating how frequently a customer account should be updated. We can reduce bad debt losses by using credit holds carefully or judiciously. We need to use credit holds whenever necessary to motivate delinquent customers to pay past due balances sooner rather than later. And we recognize the link between bad debt losses and payment delinquencies in this way. The further past due an account becomes, the further past due a debt is, the less likely it is that the customer is going to pay, and the more likely it is that we're going to have to write it off. Number four, require active customers to provide updated financial statements periodically, for example, once a year. And while we're talking about financial statements, generally speaking, what the credit analyst will want to see is the customer's balance sheet, income statement, and statement of cash flows. Another way to reduce bad debt losses is to think carefully about a decision to take an account off credit hold simply because the debtor company finally got around to paying the past due balance, the balance that resulted in the account being placed on credit hold. My position is this: if an account was bad enough or far enough past due that they ended up on credit hold, just because they finally paid you doesn't justify an immediate decision to offer open account terms. Instead, my position, my opinion is this: before you reestablish open account terms, you need to update the file. You need to evaluate the risk. You need to determine whether or not it still makes sense to extend credit to that customer. Finally, consider offering a cash discount to encourage early payment from customers. Ways to reduce bad debt losses continued. Try to close any loopholes that permit orders to ship without credit approval. We've talked about the idea of setting appropriate credit limits. We also need to be in a position where we either increase or decrease those credit limits when that becomes necessary. We can reduce losses by making sure that customers and applicants agree in writing to our company's terms of sale, our terms and conditions of doing business. We can reduce bad debt losses by collecting more quickly, and we can collect more quickly if we use the phone as our primary debt collection tool. We can reduce write-offs by resolving disputes and deductions more quickly. We can make it more likely that we get paid and therefore have less bad debt losses if we utilize credit enhancements, such as, for example, guarantees, personal guarantees or intercorporate guarantees, liens, letters of credit, and credit insurance. Ways to reduce bad debt losses continued. Another way to reduce bad debts is to refer all unpaid debts to third parties, such as a third-party commercial collection agency for collection. As customer balances age out, we should encourage and require the collector to discuss those accounts with their manager. The idea behind this and the way in which this reduces bad debts is when the collector is able to interact with their supervisor and discuss ways in which the debt can be collected more quickly and more effectively, that has a tendency to reduce delinquencies and has the added benefit of making the debt more likely to be collected. We can reduce bad debt losses by training collectors to request or require a minimum payment when they're discussing the status of an account with a past due customer. And we can reduce bad debt losses by learning to deal more effectively with common excuses that are used by customers to delay payment. I want to offer just a few perspectives on debt collection techniques. Comment number one, the more flexibility the collector demonstrates in discussions with delinquent customers in connection with a fair and reasonable and appropriate payment plan, the wider that collector may be opening the door to abuse of your company's standard payment terms. Another perspective on debt collection is this: the louder the customer complains and protests about a negative credit decision, such as, for example, a decision to place an account on credit hold in response to the account being past due, the more likely it is that that negative credit decision is in fact the appropriate decision. As it relates to debt collection, always expect immediate payment in full for the entire past due balance, and therefore, as a collector, always ask for and always expect immediate payment in full of the entire past due balance. Finally, never renegotiate a payment plan. If your company has made the concession of agreeing to accept an extended payment plan from a customer, there should not be a situation in which you would agree to renegotiate, because in effect, you would be negotiating against yourself. You've already negotiated an extended payment plan. You don't want to agree to extensions on what is already a non-standard extension on when you expect it to be paid. Thank you very much for your time and attention. I hope you found this presentation to be interesting. If you are interested in hearing the entire 1-hour presentation on these topics, please contact the Sponsoring Credit Association for more information about how to obtain the on-demand program. Have a great day.